Welcome to The Pitch, brought to you by Livewire Markets. I'm Hans Lee, and joining me today is Chris Smith of Intermede Investment Partners. Our conversation today is about all things global stocks, but perhaps maybe not the ones that you've heard so much about over the last couple of years. Chris, welcome. Great to have you with us.
Yeah, thank you.
So, tell us, just to set the scene, tell us about Intermede's approach to investing in global equity markets.
So we are looking for high quality companies that compound year to year, that are well managed, that generate a lot of free cash flow. So we look for companies that are currently producing, not expected to produce down the road. We own a fairly concentrated portfolio of those companies. It's around 40 stocks at any given point in time, and we ideally will own them for many years. So we've had a number of positions in the portfolio since we started out 10 years ago, and our average holding period is a few years plus.
Yeah, no, absolutely. So what I find interesting reading your documentation is that, yes, tech is your largest individual sector, but at the same time, nearly 3/4 of the portfolio is not in tech stocks. So we thought we'd spend this interview talking about the other 3/4, as it were. Two of the other sectors you've got large exposures to there, financials and healthcare. How do you go about finding growth opportunities in these two sectors?
Yeah, so I think you have to be quite selective within financials in particular. So a lot of the benchmark is in names where there isn't as much growth and where we don't consider there to be a quality angle to it. So a lot of banks, a lot of insurance companies. But also within financials, you have payments companies. You have companies like MasterCard, has been a position in the portfolio for the last 10 years. You have S&P Global, which is a data company providing very mission critical information, whether it's indice data or credit information that's required for bond issuances. We have exchanges like Chicago Mercantile Exchange. So when you put all that together, we end up typically with an overweight position in the sector that you wouldn't think would offer the sort of opportunities we're looking for. In healthcare, that's an area where there is a lot more growth generally, given the aging populations, given all the innovation that's happening in that sector. For us, one of our favorite holdings is Novo Nordisk, the maker of the anti-obesity drugs, the GLP-1s. We feel that there is a tremendous opportunity ahead of them there in their current portfolio of products, and they also have a very deep bench of additional pipeline products coming down the road that will have fewer side effects, we believe, and also be easier to take for the consumer. So lots of opportunities in healthcare.
Okay, all right, so that's Novo Nordisk. You're talking a little bit there about Chicago Mercantile a little bit earlier, so that's about finding growth opportunities in those two sectors. But as an analyst, I'm interested, your primary focus is actually on global consumer stocks, and boy, has the consumer been an interesting story over the last 4 years. We got real wages, well, they were going up, they seem to have now stagnated a little bit, interest rates relatively higher, consumer confidence still weak. I'm curious, how do you seek out good quality consumer-facing opportunities in this kind of an environment?
Yeah, it has been an interesting environment. I would say that the one thing to really focus in on that's really key to consumer spending is employment. And employment levels have remained quite healthy in much of the developed world. Pretty much all markets were at near record lows. So consumers are feeling relatively good. Now, inflationary pressures have been pronounced in many places also, so that does lead to lower consumer confidence, but the spending is still happening. So we see a lot of opportunities in places such as travel. So we have Airbnb in the portfolio. They continue to expand their platform. They have very high market share, and people keep traveling, and they want to have more than just a hotel room for certain of their stays. So that's been a good area of growth. We have names like LVMH, which has a great portfolio of brands in the luxury space, seeing good growth. There's been a depressed spending from Chinese consumers, but that's coming back a little bit actually this year, so up 10% in the first quarter of the year, that cohort, when you combine their spending outside of China itself, where it's maybe down a little bit, but here in Australia, I'm sure you're seeing a lot more tourists now, and spending is up. So a lot of attractive areas within consumer, and overall we're a little bit overweight.
Can I just follow up on Airbnb and LVMH together? If I think about that travel and those luxury thematics, are you saying to me then that you want to be in those higher end consumers then? Is that the kind of places you want to be within that particular demographic?
Yeah, the higher end consumer has been better able to handle the inflationary pressures, and budgets are more, there's more freedom in the budget to be able to travel more. And people, I mean, the pandemic's now a little ways in the rearview mirror, but people still want experiences over goods. I mean, LVMH is kind of doing both things in the sense of providing luxury experiences, but yeah, I think the higher end is the place to be.
And the only reason I ask that, of course, is that, correct me if I'm wrong, I think McDonald's is in the portfolio.
Yes.
So that's kind of like the opposite side,
Yeah.
almost, as it were. Do you hold McDonald's almost like as a bit of a barbell, like having some of what people need as well as what some of people want, or what's the rationale behind that, I guess?
Yeah, so McDonald's, it depends on the market you're in. So some places it's more of an affordable luxury. In a developed market, less so. It's more consumed by lower income consumers to a larger extent. It is a place where if the consumer environment were to soften, there's often a trade down into fast food and that sort of environment from a more expensive sit-down dining experience. So it can perform well through the cycle, which is something that we like about it. It's a company where they make the vast majority of their profits from just a few markets, with a lot of potential to improve profitability in the other 100 and some countries that they operate in, which is what we've been seeing, and a reason for us to have recently bought it.
Yeah, no, absolutely. Chris, this has been a fantastic conversation. Thanks for joining us here at Livewire.
Yeah, thank you very much.
And thanks for joining us for another episode there of The Pitch, another great episode of The Pitch. If you enjoyed that, you can subscribe to our YouTube channel and to the Livewire Market Index websites. And we thank you for watching.